Good morning, traders. Good morning. Good morning. Just going to give you a few seconds to enter the room, and we'll get this underway. All right, so look, good morning, as I said, and a very warm welcome to this presentation on RSI trading strategies. As always, I want to thank everyone for taking the time out of their busy schedules to be here. I genuinely hope you're able to walk away from this presentation a more informed trader. Now, those new to the FP Markets webinars, my name's Aaron Hill, and I'm one of the market analysts here at FP Markets. Now, look, I assume the visuals are all good. You can see the welcome slide here, and you can hear me loud and clear. Look, if there are any issues, do let me know, and we'll try and get our friendly support team on the other end of this webinar to try and sort you out. So for those interested, a recording of this webinar will be available through either the FP Markets website or FPM's YouTube channel. Our friendly support team will also email attendees with instructions on how to view the recording. Right, so as usual, guys, a disclaimer as you can see, guys, there are links in the chat box now. So that's where you can access all of the recordings and previous recordings by other analysts. So disclaimer, the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. Really, guys, all this means is anything we discuss today is considered educational advice and does not constitute investment. Does not constitute investment advice. It's purely educational. All right, so here's today's. As you can see, we do have quite a lot to get through, and relative strength index. I'm going to briefly define it and offer you the formula. Ways we can use the RSI. We can define current trends. We can highlight overbought and oversold signals within a market, divergence signals, failure swings, and why the RSI is an ideal confirmation tool. Yes, so, and we'll also wrap up with a Q&A, but if you have questions during the presentation, do feel free to highlight those questions, and I'll see if I can answer them as we go along. Now, I'm just going to switch over to our trading view. Just bear with me. I'm going to have to stop sharing and reshare the screen. Sorry about this. Just bear with me here. Just bear with me, guys. Sorry about this. There we go. Right. So share. Okay. You should see now. You should see the. Just want to briefly check that you can see the correct screen. All right, brilliant. So look, this on the screen right now, we have the euro-dollar daily chart with the RSI attached to the bottom of it. It's in an isolated window. So look, the relative strength index is short for the RSI and was designed by a chap who goes by the name of J. Wells Wilder. Now, Wilder actually features the RSI in his 1978 book, New Concepts in Technical Trading Systems, I believe. And look, this was developed 4 decades ago. And look, the RSI has, shall we say, stood the test of time and remains one of the most popular technical indicators today. So at its core, the RSI is a momentum oscillator. It is there to measure the velocity of directional price movement, shown by way, as you can see here, of a value between 0, you can't see, but it's between 0 and 100. The basic framework of the indicator consists of an x-axis, as you can see at this is the horizontal panel here, and a y-axis. Excuse me. The y-axis consists of represents the magnitude or distance the indicator has moved. We also, as you can see here, we have notable levels of, well, they should be better highlighted than this. So the notable levels are 70, which denotes the overbought level, 30, which denotes the oversold level, and there's a 50 center line here, which is your center line. So a reading above 70 does actually is considered overbought, and moves below 30 is considered oversold. More on this in a little bit. Now, as I briefly said, think about momentum in terms of the speed of price change. Now, for example, if we have a handful of traders buying into a market, now this can be any market, and price advances, more traders see this movement. Okay, as more and more traders see this movement and trade, consider momentum traders, for example. And before you know it, we have a strong wave of bullish activity. This occurs every day. The question most traders and investors ask is, how long will the market remain in this advancing state, if you will? Are buyers going to run out of fuel or overheat, so to speak? So price cannot continuously rise. Also, as momentum turns lower and the market sells off, it often tends to over-deliver or to on the downside. So another way to think about this is markets are often overreacting to good and bad news. And this really is where the RSI tool can really come in handy and help decipher this movement. Now, generally, the RSI indicator is considered a leading indicator. Now, a leading indicator essentially provides a signal before a new trend or reversal occurs. However, I've also seen some traders refer to the RSI as a coincident indicator, which means that it works almost in line with the almost real time. So providing information about the current situation on a particular chart. For me personally, I feel the RSI is more leading than anything else, but this is really just my opinion. So with all of what I've just covered, for me, a basic definition of the RSI is really there to measure momentum in a particular security, be it stocks, commodities, foreign exchange, cryptocurrencies, for example. And Wilder, the gentleman who developed this indicator, basically reasoned that if gains were significantly greater than losses over the period, then the stock or currency was overbought. And if losses significantly exceeded gains, then it was considered oversold. Obviously, do not confuse this with relative strength, which is a different animal entirely. So for anyone interested in what I'm talking about here, this is essentially a ratio method. In other words, it's a ratio between two instruments. So between stocks and an index, for example, which one is outperforming the other. Now, the key point in this presentation is to understand that the relative strength index measures the momentum in one market, so the euro dollar in this case, and on one time frame. It's very important. Therefore, traders who prefer lower time frames, so think of the M15, the M30, the hourly chart, and scalpers and day traders tend to use the lower time frames. They can use this indicator on that set time frame. And also we have swing traders and position traders, and they can use that indicator on, say, the H4, the daily time frame, the weekly time frame, and so on. It's also important to note that the default period for this indicator is at 14. But traders do adapt this to their trading style. So a lower period will, of course, increase the indicator's sensitivity, and a higher period will, of course, reduce the sensitivity. Look, this is very basic. I'm sure most of us are aware of this. I just thought, just in case we have any newer traders here, just to give them a basic introduction. So it hopefully makes more sense as we progress. All right, so in terms of the calculation, I've prepared this this small box here. I do believe it's actually quite important to understand the indicators formula for this to really understand how the signals that are being given. Although it's not necessary, I do believe it is very, very helpful. So the calculation presents a number between 0 and 100. Now, the relative strength, or RS, as you can see here, is the average of all up moves and down moves over the last 14 periods. Now, to calculate the average, forget this for the moment, but to calculate the average, you must sum the up moves and down moves and divide by 14. That's the default calculation period. The trader can then divide the average gain by the average loss values to produce the relative strength, which, according to the formula, is increased by 1, as you can see here, that's bracketed off. RS increased by 1, and following this, we divide it by 100 and then minus 100 to give us our RSI signal. Now, so I'm just trying to think of the easiest way I can offer you this. So look, the relative strength is the, as I've said, is the average of all the up moves and over the last 14 periods. So we don't really need to do this. All we need to do, as you can see on the calculation, we have the previous average gain. So you'll have this. You can calculate this if you wish, but there are many websites that do provide this. You can have the previous average gains and you multiply that by 13 and then divide that by 14. And that gives you your average gain. You can do the same, previous average loss, multiplied by 13, divided by 14. Now, an example here, as you can see. Now, let's imagine our average gain is 0.24 and our average loss is 0.1. Okay, this is percentages. Now, if we divide these two, we arrive at 2.4. If we add that to 1, we get 3.4. Divide that by 100. Look, I'm following the same formula here, guys. We divide that by 100, and that gives us 29.41. And then once we have that, we just simply minus that from 100. So it'd be 100. I should have had 100 there. 100 minus 29.41 gives us 70.459. And that would be our RSI value in this case. Now, do be aware there is a rounding issue. I have rounded this value, but if you go into Excel and you compute the full values, it will be slightly different. Not too much, but it will have a slight difference there. So I'm going to now delete this unless there are any questions on this calculation, which there shouldn't be really, because look, you can rest assured that most reputable charting packages do calculate this efficiently, so we do not really need to concern ourselves too much with this, but it's just understanding that we are calculating the average gain over the average loss. It's all about the average gain and average loss, okay? So, for instance, when we cross the 50 center line here, average gains are said to be increasing against average losses, okay? This is something that should become more clearer as we progress. So first up, defining the trend or current movement. This was the first, one of the first topics on our to-do list. So let me just remove this cursor here and go with the arrow. Okay, so defining the trend. So personally, I know of 2 ways to help define the trend using the RSI. Now, I do not use this. I just want to be clear. I do not use this to help define trend in any way, shape, or form. I'm more of a price action trader, and I look at the price action to tell me when the trend is changing. But you can use the RSI. So in this instance here, we have the RSI crossing to the upside. This is the 50 center line crossing to the upside. All right. Let me just highlight the 50 center line so we all know what we're talking about. All right. So that's the 50 center line. So an RSI crossing the 50 center line, an RSI center line crossover, if you will, in the direction of the 70. Let me mark that up as well. 70 threshold. And this is your overbought threshold there. In the direction of the 70 overbought threshold, the trend is increasing in strength, but you can see that from the price anyway. Essentially, this is a bullish signal. Now, price crossing above the 50 center line, if you think about it, informs us that the average gain is larger than the average loss. All right, so that goes back to the calculation. The average gain is larger than the average loss. So what does that tell us? It tells us we are in a market that's, according to the indicator, offering positive momentum at this time. Now, a falling centerline crossover. Let me just try and find one here. So we have one here, a falling centerline crossover in the direction of the oversold level. Let me just mark that up, 30. All right, so we have a 50 centerline cross, a falling centerline crossover, if you will. And this occurs when we cross below the 50 centerline in the direction of the 30 oversold threshold. Which indicates that the trend is weakening. So we have negative momentum. And this, if you think about it again, in line with the indicator, informs us that the average loss is greater than the average gain as we continue lower. Now, so really that's all there is to this. As I said, I don't use the RSI centerline crossover, but some people do, some traders do, and they seem to be doing nicely from it. I've just found no use from it. I prefer looking at the price chart for that kind of thing. Next up, we have overbought and oversold signals. So beyond 70, we have our overbought area, and beyond 30, we have our oversold area. Now, just quickly, overbought is essentially telling us that we are dealing with an overvalued security, a potentially overvalued security. I say potentially because there are instances where price can remain within overbought for prolonged periods. I will get to that shortly. But yes, just as a basic here, above 70 is considered overvalued. Below 30 is undervalued or oversold. Okay, and what this tells you is once price enters this area between 70 and 100, we could potentially be in line for a price decline. All right, so once we test the oversold, we could be in line for a potential, as you can see here, perfect example, oversold here, and price reacts to the upside. So it's warning you, it's a red flag that we could see price turn to the upside for oversold and price turn to the downside for overbought readings. Now, a key point to note is that the RSI tends to top and bottom out prior to price action. Not too much. There's not much of a leading signal, but as you can see, we bottomed out here and then price rallied to the upside. A mild bottom there, and a mild bottom here. And yes, so this is something to keep in, and this almost precedes a reaction. And these tops and bottoms form within the overbought areas. So as you can see, bottoms, 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 look, think of these areas. Think of the oversold area and the overbought area as zones where, in terms of the overbought, buyers show exhaustion, and in terms of the oversold area, sellers show exhaustion. So when upside momentum is drying up and downside momentum is potentially drying up. Look, the point I really want to get across is these can offer false signals, especially when we're in downtrending market. So look, this is a perfect example. We are now in a downtrend, right? And it's not always viable to short overbought levels, and not always viable to enter long from oversold areas. And this is because, as I said, we can remain within the oversold region for prolonged periods in trending environments. Now, as you can see here, we are in a clear downtrend. And look, here we've actually been very lucky in terms of, so we had an oversold signal at this point here, price turned higher. But we are in a downtrend, guys. We are in a downtrend, right? So we don't really want to be committing too much to this move here. Oversold, price does pull back. Oversold, price does pull back. But look, we hit oversold here. There is divergence here. I'll get to that shortly. But oversold, pullback. Oversold, pullback. So there is if you are a counter trend trader, this could be something you want to consider adding to your trading strategy. But another point I really want to get across is in downtrending markets. So we have a clear downtrending market here. All right. So with that being said, when you have a clear downtrending market, you will often find the RSI. Now, we know between 70 and 100 is the traditional overbought area. But in downtrending markets, this usually switches to between the 60 and the 50 area. So as you can see here, between the 60 and 50 area, we have a temporary oversold. We can even extend this right back to here. I wonder how far that goes back. See, that goes back quite a way, all the way back to the beginning of this down move. All right, so look, since this is a really good example, actually, since May of 2021, we have had a temporary, you can think of this as a temporary overbought area. Now, this is where you can look for divergence signals and things like that when you're in a downtrending market. Because look, if you're looking for, look, the idea is when you're in, you identify your trend, and then you look at the overbought and oversold areas for potential red flags of when you can look to short the market from overbought and look to enter long from the market from oversold. So logic states that you really don't want to be entering long from oversold in downtrending markets, although they have worked quite nicely here. But the idea is to look for overbought signals within downtrending markets. But as you can see, we rarely hit the overbought region, hence why you'll often see we have a temporary overbought region between 60 and 50 here. And this is where you can take your overbought signals from. Sorry, I should have left my crosshair on there. So we have an overbought signal here, potential sell there. An overbought signal here, potential sell there, potential sell there, potential sell there, potential sell there, here, here. It almost looks too good to be true, right? Here, here, and here. So it's highlighted every single sell-on rally scenario. So this is something to really keep in mind. And this between 60 and 50 also occurs in uptrends. So let me just try and find an example of this. But instead of 60 and 50 above, it goes from 40 to 50 below. So here you can see a small region here within this uptrend. We have a temporary oversold region here. Instead of looking at this area here, we're now looking between this area here. So you can see here was a potential, I'm not sure if I would have traded that, to be quite honest, around this region here, potential indication that we could dip buy at this point. Here, look, it wasn't a great example, but I hope you get the idea of what I mean. Now, a good example of this is on the dollar yen. If you look at the daily RSI, that provides a much better example. But so look, I really hope you get the idea of what I mean, especially in trending environments. Any questions, guys? Look, we'll stay on this chart and I'll answer any questions you have. Now, RSI divergence. Wilder actually stated in his book that divergence signal is the most indicative characteristic of the RSI. So divergence is formed when price movement and the RSI indicator diverge, move in opposite directions, if you will, which can provide a healthy cue of a market turning point. Look, we use divergence in everything. We use divergence in volume. We use divergences in, well, you can use divergences in the Dow theory. That's another trending system as well. Divergence is essentially a signal that the current trend on the chart traded, that is, has or is beginning to lose momentum. That's key, is beginning to lose momentum. It's the opposite of a confirmation signal, which is so when the indicator and price are in line. So this is an ideal area of a confirmation signal. So price and the indicator is in line. Now, again, I do need to reiterate that divergence is a warning sign, nothing more. It's a warning sign that momentum is beginning to slow. So momentum, or the speed of price change, is, as I'm sure most of you know, is helpful in assessing trend strength. So the RSI does a reasonably good job in telling traders when the trend or decisive movement is slowing. And this can be looked at through a centerline cross, as we discussed already. This centerline cross, rising centerline cross, falling centerline cross, overbought, oversold signals, or even, do you remember the temporary oversold signals, temporary overbought signals, and temporary oversold signals between 40 and 50 and 60 and 50. Divergences through experience, I do know of a number of traders that can detect when when momentum is slowing. Look, I'm going to give you an example here, a clear example of a divergence, as you can see it on the chart. So in this point here, let me just highlight this area here. Now, guys, feel free to answer this question. Do you feel momentum to the downside has slowed within this region compared to this region, compared to this momentum drop here? Yeah, feel free to answer in the chat box. I'm just going to draw up the divergence signal, so it's clearer. In fact, you know what I'll do? Just so it's clearer, let me just reshare this screen. Because I really want to go through this. I do have this prepared. Let me just share that. Right, I do hope you can see this screen here. Okay. Right, okay, so this is taken from the FP Markets design team. As you can see, we do have a number of strong, moderate, and weak divergences. Let's just focus on the strong versions for now. Strong version here and the strong version here. So as you can see, we do have regular bullish divergence and we have hidden bullish divergence. This is the regular bullish divergence and this is the hidden bullish divergence. Right, so in terms of regular bullish divergence, what you'll see is, bear with me, in terms of bullish divergence, you will see price form a lower low. All right, so think of a lower low in a downtrending market. But at the same time, you'll also see the oscillator, in this case, the RSI, form a higher low. Quite clear here. And what this is telling you, is that downside momentum is beginning to slow. All right, so downside momentum is beginning to slow, and we could see bulls potentially make an appearance because downside momentum is beginning to slow. I'll show you on the chart very shortly of how you can recognize that without the indicator. Bearish divergence is exactly the same, only the mirror opposite. So price, as you can see, forms a higher high within an uptrend, but the RSI indicator is forming a clear lower high, which you would witness within a downtrend. So what this is telling you is that although momentum is to the upside right now, it is slowing. It is slowing. So it's a warning signal that sellers could potentially make their move shortly. All right, so this is your strong, regular, bullish, and bearish divergence. I won't go into the moderate and weak versions because it's pretty much the same. And look, if you want this slide, this image here, please feel free to email me, and the research team will get back to you with this image. No worries at all. Now, in terms of hidden bullish and bearish divergence, this is it's almost like the price and oscillator swap roles. So for bullish divergence, we can see price forms a higher low. All right. As you would see in a normal uptrend, price forms a higher low, but the oscillator, the RSI, has formed a lower low. Now, as I said, what this means is price and the RSI have swapped roles. And price is essentially saying that although momentum is slowing to the downside, is moving to the downside, we remain strong. So this is potential divergence, and the reason it's hidden is because sometimes it's very difficult to see. And just to be clear, hidden divergences usually form as continuation signals. The bullish and bearish regular divergence are always actually reversal signals. Okay. Always reversal signals. The hidden are reversal signals still, but they are continuation signals within the underlying trend. This can be confusing sometimes because you can still see regular bullish and bearish divergence within a clear trend as well when price is looking to, let me just draw this up because I want to be clear. I hope you guys can see. So we have a trend higher and we have, say we want to buy this dip at this point here. Look, the chart I'm going to show you has this, but we have the RSI as terrible drawing. Look, the chart I'm going to show after this will show it a lot clearer than what I'm drawing there. So look, hidden bullish and bearish divergence. Price forms a higher low, indicator forms a lower low, but price takes command at this point. Bearish divergence, mirror opposite again. We form a lower high in price, but the indicator forms a higher high. But the higher high is weak in this point, in this potential, in this setup. Price takes command. Price takes the lead, if you will. So look, any questions, or if you want this, that slide, that image, please do let me know, and we'll try, and I'll send that across to you, no problem. All right, so back to the euro-dollar daily time frame. Now, this is the example I really wanted to show. We can see here we have positive, regular, bullish divergence. Okay, positive, regular, bullish divergence, and this is shown from this low here to this low here, and from this low here to this low here. So what we have is a lower low in price, which tells us what? We are trending lower. But look, in terms of the RSI, we have a higher high, a higher low formed, which tells us that momentum is slowing. Now we can see this on the price chart. We don't need to be rocket scientists to see this. Price, look at the momentum is considerably stronger than this area here. Just think of it as blocks. So we have a block here telling us decisive momentum to the downside is in play, but that's now swapped with an area where momentum to the downside has begun slowing. So again, picture this. Remember that's only a warning signal, but they are very accurate if you learn to pinpoint them at the right places. Another point I really want to get across is the closing prices. Now, I find a lot of traders, they mark up their divergences from the lows to the lows or highs to the highs using the extremes of the candles. Now, the calculation, as you've seen, is based on the closing prices. All right, so your divergence needs to be drawn from the closing prices, not the outer extremes of the candles. Right, okay, we have a few questions. Lionel, where do you take your buy entry? Now, bear with me on this. I'm only talking about basic divergences right now. I will show you a potential, or not a potential setup that did occur, but you could just to offer you a basic answer to your question, where do you take a buy entry? You could look for a bullish candlestick signal. Don't forget, this is the daily time frame. You could drill down to the lower time frames. Now, let's assume there is support at this point here. All right, although we are trending low, we have support here. We have bullish divergence. That's clear. Now, once we test that support and we start to see signs that we have early bullish divergence here, this is when you can look for buy entries. And I always look to drill down to the lower time frames and find your entry there. You could find some really nice entries. I mean, we can go and have a look if you want, but we could try and find some entries here. You could use harmonic patterns as confirmation. You could use lower time frame RSI confirmation and things like that. So look, we have one more question from Stefan. Which is a better situation for RSI, short time frames or bigger? Now, I found that, look, the consensus is that the the larger time frames offer more accurate signals. I agree to a point. I do understand why, but really from the H1 upwards, I'm very comfortable using the RSI from the H1 upwards. But I do see that the signals do occur on the 5-minute time frame. Just to show you what I mean, let's go down to the 5-minute and let's have the RSI on. Let's try and find a divergence. Again, guys, look, this is cherry picking here, and I try my best not to do that because it doesn't really show you much. Look, we have some bearish divergence here, close to close. Remember, close to close, price close, and we have the RSI forming a lower high, but the price action forming a higher high in terms of closing prices. Here we have a signal to short, but of course the signal to short 99.76 offered you a move of 99, say 46. That's 20 pip move. All right, so you have to take that into account, of course. Whoops, if you're planning to trade or scalp shorter time frames. But for me, I would always stick with the H1 and higher. Now, that's not to say that you should do that. That's just what I found to be more comfortable. I hope that answers your question, Stefan, and I hope that helps you a little bit, Lionel, with your question. All right, so let me just get some water. Bear with me. All right, we also have, let me just remove this. There was some more divergence here. Right, so this was a very good example here. This is negative bearish divergence at this point here. So we have, again, 2 blocks. Let's look at the blocks of price action. There's the block of price action here and another block of price action here. Right, and if we look at the indicator here, we can see that momentum was more decisive within this block here than this block here. I mean, look at that bearish candle here. That's pretty intense bearish candle there. And if you look on the RSI indicator, it's showing us that momentum is turning to the down or beginning to slow. Upside momentum is beginning to slow. So all this indicator, look, the indicator is a derivative of price action, nothing more. All right, so all we're using this is until you train your eye to see that momentum has slowed to the upside through price action, you can use this indicator to help you. All right, so just remember this. It is an indicator of price action. Sorry, a derivative of price action, excuse me. So we have this, and look, let me draw this up for you. We have the closing price to closing price, and this shows us divergence. Now, I will be clear, for me, I always look for regular bearish, and this is regular bearish divergence here, and regular bullish divergence to form within oversold or overbought areas. I do not take regular divergences outside of these areas. So this is what I like to call no man's land between 30 and 70 shaded in here. I will not take the regular divergences at that point. Any questions on this, guys? It should be pretty self-explanatory, as I think I've shown it on far better than I would have done if I'd have attempted to draw the picture. So look, in terms of hidden divergence, we do have one here in August. I think it was August here. Here we go. Now, I hope you guys can see this. Closing price, whoops, to closing price. All right, so let me just pull that down a bit. Let's go to the closing price there. Closing price to closing price. But on the indicator, we have what? We have higher high. Remember from that slide, this is hidden bearish divergence. Again, this will rarely form, this seldom forms within overbought and oversold areas. And this is, remember, this is generally a continuation signal within a predetermined trend. So we are to the downside at this point. Our trend is lower. All right, it's an early trend. It's an early downtrend, if you will. But this is where you look to short. And look, for any candlestick enthusiasts that are present, we have what here? We have a Japanese candlestick, and it's a shooting star, or a bearish pin bar, if you will. I know some traders like to refer to this as the bearish pin bar. but Japanese refer to it as the shooting star. So we have that as confirmation. We have a bearish, hidden bearish divergence, so hidden negative divergence as well. Guys, are there any questions with anything you do not understand in terms of what I've shown here? I just want to be clear. Just want to. I hope it all makes sense. I don't see any questions. I don't see any comments now. Right, so that's the next technique. Right, another technique is the RSI failure swings. These are not that popular actually, which surprises me because they are very, very strong indications of a market reversal, and they can actually form following a divergence signal. So they can almost offer you confirmation of a divergence signal. So March and April of 2021 highlights a a combination of things. So it highlights a combination of divergence. I hope you can see this, guys, without me pointing it out. And it also highlights a bullish failure swing. Now, a bullish failure swing, just to offer you some context here, I just want to make sure. Yep, okay. So a bullish failure swing is a bottom. It's a bottom within the RSI. So we first have a bottom that exceeds, as you can see, if you look to the far left of my screen on the RSI indicator, 29.54. It has to exceed the 30 threshold, the overbought threshold. So we've exceeded, let me remove this cursor, it's highly annoying. All right, so we exceed the oversold threshold at 29.54. That's the first step. Number one, we bounce back and we form a lower high. This lower high is here. Of course, we don't know that at the time, but we have to wait until the RSI figures out what it's going to do next. Then we pull back. Look, generally, I do not like to see price, do not like to see the RSI indicator dip back into oversold anyway. But the key thing to watch out for is the indicator should not surpass the previous low, as it hasn't done here. Look, the indicator, the low is at 31.49. Look to the left of my screen, 31.49. This was 29.54. So that's the third step after the lower high. Now, following this, if we get a break of this previous lower high, that's a bullish signal. That's a bullish failure swing. Now, prior to this, we also had what? What's this? It should have jumped out to you. This should have offered you this was a bullish, regular bullish divergence. As you can see here, let me draw it on the chart as well. From this point to this point, closing prices to closing prices. And look, it already tells you on the chart. If you want to learn how to read price action, I would wholeheartedly recommend you do that. Look at the momentum here. It's pretty clear that the momentum here is mildly stronger than this area here. And this shows on from the bullish divergence. But not only have we bullish divergence here, we also have the RSI failure swing, which, let me just summarize. The first point is a bottom within that surpasses the oversold 30 threshold. This is followed up with a lower high, and then this is followed up by a subsequent dip to a higher low, which clearly does not surpass the previous low. Then this has to break above the previous high to offer a bullish signal. So at this point, let me just draw this up. At this point here, we have confirmation. So it's on that candle there, we have confirmation. This candle here, we have confirmation of not only bullish divergence, we also have confirmation of the bullish failure swing. Is the RSI similar to RS ranking? No, as I said, Manpreet, at the beginning of the, I guess you could say is a little bit, it has some similarities, but really for the RS, I assume you're talking about relative strength. A relative strength compares one market to an index or something like that to see which is outperforming. Here, we're just looking at one security, so the euro dollar in this case, and we're not comparing it to anything. It's just based on the price movement of this market. I hope that answers your question. So yes, at this point here, we have confirmation of not only the bullish RSI divergence, we also have confirmation of the RSI bullish failure swing. Now, I won't go over the bearish failure swing because it's just the mirror opposite, unless you want me to, guys. It's up to you. But there is one here. We can see here, high, low. The high does not surpass the previous high, and then we break below the previous high or low to get our signal. And this, again, guys, follows on from the regular bearish divergence. It adds confirmation to your bearish divergence. All right, so with that out of the way, look, another thing we can use with the RSI as a strategy, we can also use this to find patterns. Now, do I go and look for bullish and bearish flags on the RSI? I do not. I do not really look for that. I do look for the odd ascending triangle and things like that. But look, mainly I look for clear support and resistance on the RSI. This can be used. Trend lines as well are something else you can use on the indicator. I just thought I would put that across. If you're interested in potentially drawing up patterns on the RSI, this can be done. Traders do it, and traders do use it for their trading. Now, we've seen some various ways in which traders interpret the RSI. I thought it would be good to round off how we can use the RSI in trading, how we can these techniques. Now, if we look at this signal here, if we put our and we go back in time, let's see what that lined up with. I mean, look at this. Look, this was clear support for anyone to. This was a clear bottom in price. So there is a chance, even though we are in a downtrend, the price would bounce. Now, we use the RSI, well, I use the RSI as confirmation. Price action always comes first, guys, for me. Price action always comes first. As again, the RSI is simply a derivative of price action. So price action comes first. And from that support there, we have confirmation in the form of what? We have confirmation in the form of an RSI bullish divergence signal within oversold territory. All right, so we have confirmation. We have confirmation of this support. Let's see what else we had here. So we had, remember, we had this this RSI bullish divergence. I do not really see anything here. There's nothing really. I mean, you could say we have this demand area here, which was actually a very nice decision point, and I would have taken that. But the thing that really would have turned me off was this point here. It's already being tested and weak and potentially weakened, hence why we did actually snap below this area by a couple of pips. All right, so there's something to bear in mind. I always look to align the RSI with price action techniques. Now, this doesn't have to be just support and resistance. It can be other indicators if you want. It can be the MACD. Look, MACD, stochastics are all the same thing, really, aren't they? They measure momentum. And if you look on the chart, they do offer very similar signals if you're trading on the same time frame. So if we had the MACD applied here and the stochastics on the daily time frame, you would really get the same signals, very, very similar. But if you use the stochastics on the H1 for more confirmation, more power to you, because that could be a good potentially a good strategy to use. So yes, you could use trend lines, you could use supply and demand as I used here at decision points, and things like that. So it's up to you to test this. It's up to you to back test this. Look, I will leave you with something here, because my mentor many moons ago showed me his strategy. It was so basic. It was so basic, and he was making very good money. He's now retired, but he was making very good money from this. So a basic trend line. Let's go here so we can try and find something. But he would use trend line support and resistance. But he traded futures as well, just to be clear. And he would look for a trend line resistance that converged with divergence or something like that. So let me see if I can find an example for you. No, this is not really anything here. Look, for anyone that's interested in head and shoulders, we do have a mini head and shoulders here on the RSI. So if you're looking for patterns there, look, I don't really see anything, but there's something to be aware of. You can combine trend line support and resistances with RSI divergences and things like that. I'm just trying to think of anything else I really want. Look, the thing I really wanted to get across was confirmation. We use the RSI to help confirm other technical tools. Of course, as I've said, technical tools will vary from trader to trader. For me, I'm a huge fan of price action, and I always look to include trend studies within my analysis. So if we are in a downtrend, I generally only take overbought signals, as I showed you with the 60 and 50 area here. Do you remember the temporary oversold areas within trends? And the temporary overbought areas at this point, and the temporary oversold areas at this point here within uptrends. Right, are there any questions on this chart here, guys, before I move back to these slides? If there are, I think there might be. Nope, there's no questions. I don't see any questions, guys, so I am going to move back to the slides just to really in things to wrap things up. Right. So look, guys, I really do appreciate your time. I do hope I have helped in some way, especially newer traders. And you can really walk away from this presentation a more informed trader, if you will, especially about the RSI. As always, if you want to get in contact with the team here, you can use either that should be support, not support team, excuse me, guys. That should be support. You'll have the correct emails there in the chat box shortly. Support at fbmarkets.com, or alternatively, guys, market analyst at fbmarkets.com. This will go straight to the research team, and we can get back to you as quickly as we can. If there are any specific topics you wish us to talk about, please do send across your suggestions, and we'll try and create something for you. Look, we also have a trading academy, so do consider looking at that. There's plenty of videos and articles on there, especially for newer traders. This can help a lot. We also have a newsroom now. This is a newsroom dedicated to the news, and we have this through our Twitter, a new Twitter page and a Telegram page. Please do consider signing up to that. We will be becoming more and more active as the weeks progress. Also, in terms of future webinars, we have in November, we have profit and risk measures. Now, this is something I wholly support, because this is something many traders do not understand. Gross profit, gross loss, net profit, and profit factor. We need to be able to read our trading statistics. And this is on the 10th of November at 9 a.m. GMT. Following this, we have another webinar on the 24th of November, stock trading and investing, growth versus value. All right, so that's something for any stock traders present. Let me just check. Let me just quickly check if we have any more questions or anything like that. Right, okay. We have one more. My simple thinking at this stage, RSI below 30 is the time to buy, and above 70, I think you mean, is time to sell. That's a very simple way of putting it, but you should always, look, don't just take, as I said during the presentation, do not just take these signals as isolated signals. Always look at the chart you're trading. If we're in a downtrend, consider taking the overbought regions. If we're in an uptrend, consider taking the oversold regions. Always look, at least take trend into consideration, at least. Any strategies on position sizing? We do have a couple of webinars on position sizing that are available in the archives at FP Markets, or consider just look at FP, our YouTube channel. It's all there. We do have in-depth. Also, just to be clear, we do have videos on position sizing in our trading academy. So look, head over there, and you can have there's all the information there for you. Position sizing in FX, I'm talking about here. Look, on that note, if there are no more questions, thank you so much for taking the time out of your day to join me. And look, I hope it was beneficial. Have a great day, and I'll see you all again very, very soon. Thank you very much.